When it comes to stock trading, the absolute biggest risk will always be losing money. If you don't implement proper risk management techniques, you can lose tens of thousands of dollars within minutes or even seconds. I've seen extremely experienced traders lose discipline for a moment and lose over $25,000 within minutes. The last thing you want is your hard-earned money going down the drain. The first rule when it comes down to reducing risks is the usage of trailing stops. If you remember from the previous videos, we covered the different types of buy and sell orders. One of the type of orders was trailing stop. By using a trailing stop, you provide a tight safety net that will follow your money as the stock price goes up. But if it tries to dramatically come down, it will protect your funds. The mechanism behind implementing the trailing stop varies from broker to broker. It is extremely important to learn how to use this function properly, whether it be a software or on a browser. The trailing stop can be implemented in two ways: percentage trailing stop or amount trailing stop. In the previous video, I gave an example of how the amount trailing stop works. It basically gets triggered once the price of a stock decreases by a fixed amount. The other method is by percentage. A percentage-based trailing stop will automatically sell all your shares once it decreases by a certain percentage. The percentage that you should assign for the trailing stop may vary on the type of stock you are getting into. Stocks with higher volatility will naturally need a looser stop loss, while stocks with less volatility can use a tighter stop loss. Despite this, our recommended trailing stop would be a percentage trailing stop of 3%. The strategies you will learn later in this course fit quite appropriately with this amount. But it is also very important to understand that this value will not be most appropriate for every stock. But if you had to choose a value and there is even the slightest amount of confusion as to what value that should be, you would be safe with a 3% trailing stop. The next rule that you can easily implement to reduce potential losses and secure profits is selling half of your shares when you reach a decent profit. For example, if the stock you purchased made a profit of 10%, you would sell half and keep the 5% profit. Then let the other remainder of the shares carry on, in the case that the stock keeps going up. That way, if you make a profit, you'll add to your profit, and if it doesn't, you still made 5% profit. One thing that I must tell you, from one trader to another, never ever give a stock the benefit of the doubt. Never trust a stock with your money for too long. As soon as you make a decent profit, you've reached at least 50% of your goal or target price, you should instantly sell half of your shares. By doing this, you do the following. First, guarantee profits, and second, the other half of your money can either go up, in which case you can make even more money, or if it goes down, you at least made a good profit on the first half of your money. On top of that, remember that you have a 3% tight trailing stop on the other half of your money, so even if it does go down, you only lose 1.5% of the total amount that you initially entered. This technique that I mentioned is extremely important, and when coupled with the trailing stop rule, you can drastically reduce your potential for major monetary loss. If you are trading with a software, you should assign hotkeys for each one of these rules so you can quickly implement them while trading. The next rule is slightly more advanced, but definitely something that should be utilized. There will come times when you put a buy order for X amount of shares of a certain stock. Your order may not get filled fully. What I mean by that is, say you request to buy 100 shares of a certain stock at a limit order of $5. Maybe just 20 of your shares will get filled because there weren't enough shares being sold at $5. And now that exact stock that didn't get filled has gone up to $6, and you're feeling frustrated that you could have made more money. And as a result, you just go ahead and try to get 80 more shares at $6. This is a huge mistake that a lot of traders do. The moment you get in at $6, you broke discipline because of frustration. Instead of getting in at a higher price than initially planned, wait for another good trade opportunity to emerge, or get into a different stock overall. But don't get the rest of your shares at a higher price. If your shares didn't get filled, just let it go and sell whatever shares you did get at a profit and call it a day. The next rule is, don't hold on to a stock that doesn't go as planned. Before you get into a trade, you analyze the stock and the chart. You make a certain prediction of that stock, and you think it'll go up for a certain time at a certain amount, and you will cash out when it reaches that amount. What do you do when you get into that stock and it doesn't go as planned? The answer is you get out. Whenever a stock doesn't go as planned, that means your prediction was not as accurate as expected, and the stock immediately becomes dangerous territory. Yes, it could be that the stock will go up later in the day, but instead of waiting around, you can invest your money elsewhere and make it into a profit. So, once again, if that stock doesn't move as you expect it to, don't hold on to it. Sell it right away at whatever profit you have. The final rule is, do not revenge trade. There will come times when you think you will make money, but it will be a lost day. Lost days are normal, and it is something that even the most experienced traders go through. Don't get angry and frustrated and try to take your revenge on the stock market by aggressively looking for a profit to make. The moment you feel that anger and frustration, you are no longer qualified to trade. Stock trading is all about keeping a clear and logical head. The biggest mistakes are caused when we get too emotional. If you had a bad day trading and are feeling angry or frustrated, it is time to turn off the computer and take the day off. The rules discussed in this video are extremely essential and should definitely be implemented every single day that you trade. The last thing we want is for our hard-earned money to go down the drain because we were not careful enough. I definitely recommend watching this video once again at the end of the course, just to refresh your memory. That's how important risk management is. In the next video, we'll get further into the psychology and general principles of risk management. See you guys in the next video.